Hello, and welcome to today's NSB GCA webinar. Before we begin, I'd like to note that this webinar is being recorded and all presentation materials will be posted on our website. If you have any questions during the webinar, please use the Q&A feature or email us at events@nsbgca.org. I'd now like to introduce today's speakers, Jennifer and Paul with GRF CPAs and Advisors. Thank you both for joining us today.
All right, that was a quick introduction. All right, so today we're talking about the federal contracting under pressure, and a lot of small businesses currently are under pressure right now. Why? Because there's a lot of changes in public policy, and we know those public policies impact your compliance requirements. In fact, they tend to be increased. And so today, what you need to know, we're going to provide a regulatory update, as you can see on the overview there. And we'll just stick with that slide for a minute. So let me just frame what we're going to be talking about today, because we're experiencing a little bit of a historical phenomenon in that between each of the presidential administrations, they're significantly changed. I don't know if you've noticed or not, but the two political parties address public policy differently, and it leaves us with little stable middle ground. Each transition between presidential administrations brings significant reversals and new initiative policies. These shifts have immediate and profound impact, especially in the small government contractor world, by suddenly introducing new compliance requirements with little warning, maybe catching some people unaware, and maybe unprepared. Consider the baseline of the environment of compliance right now. If you're a government contractor, a typical government contractor gets their contract has about 100 clauses. If you look in some of those standard forms, like under Section I, a lot of clauses that a typical GovCon has to comply with. On top of that, there may be agency-specific clauses. Then think of how your compliance requirements are increased. As soon as you get a cost reimbursable contract, you're more involved with the cost principles, something called the Truth in Negotiations Act. And certainly when it's cost reimbursable, you're going to have a cognizant agency involved with oversight like NDAA, Defense Contract Audit Agency. So these changes in public policy are actually, these significant reversals are tied to changes in presidential administrations. Think about it for a second. From Obama to Trump 45 to Biden to Trump 47, it seems like there's this policy pendulum. We're switching back and forth on different major areas. And they seem to overturn the prior administration and reshape initiatives. And that can leave you unprepared and maybe even a little bit in shock. Let me just give you a quick example before we start to explain how this pendulum of policies are changing. Under Barack Obama's administration, before he left office, he had a pretty benign FAR provision, FAR 23.5, and it dealt with greenhouse gas reporting. Trump 45 punted on it, but the Biden administration put in a really big thing called disclosure of greenhouse gas emissions and climate-related financial risk. And it would have distinguished between mid-size and large contractors and the amount of reporting of scope 1, 2, and 3 emissions. So these scopes are different areas of greenhouse gas emissions. In fact, large contractors had to complete climate disclosures and set scientific-based targets. To end with, if you didn't deal with this as a government contractor, now thinking that you're a small GovCon and you'd have to report on this, if you didn't, you might not be able to get a contract. So a week before Trump was inaugurated, this Biden era proposal was kind of dead on arrival, so they withdrew it. And what's interesting is that during Trump 47, they, through what we call the revolutionary FAR overhaul, that whole section on greenhouse gas, FAR 23.5, was completely eliminated. And in fact, there's not even a definition in the FAR now about greenhouse gas. So you can see the key takeaway as we talk now about the specific requirements. It demonstrates how quickly compliance expectations can change, not to mention the impact on smaller government contractors. So Jen's going to talk about the small business and its impact.
Thank you, Paul. Yes, one of the biggest things that we've seen over the last few months, essentially starting late last year, was this noticeable increase in the scrutiny around the 8A program. We spent a lot of time helping clients respond to these 8A, SBA 8A requests and working through the documentation that they were asking to provide. If for those of you who are not aware, late last year, SBA did ask all 8A participants to provide a significant amount of financial information covering the last three prior fiscal years. That included things like bank statements, financial statements, general ledgers, payroll registers, contract data, subcontracting data, and employment records. So this was a fairly significant data request. We've seen consequences of the not of those entities that did not respond. SBA did report that they had suspended more than 1,000 contractors that either did not provide or did not provide sufficient documentation, and they had began to initiate termination against hundreds of additional firms. I think what's particularly important for contractors is that the level of detail that SBA is looking at, they're not just judging your financial statements and saying, okay, everything looks reasonable. They really are digging into the transactions. We saw questions surround payments to individuals. SBA wanted to know who was paid, why were they paid, was it in payroll, was it distribution, was it a reimbursement for expenses, or some other type of payment. I want to take a second here to really dig into why they're looking. For most firms, SBA has tax data and they have personal financial wealth statements. Once they have this information, they're very easily able to track back if a partner in a firm or an owner took a distribution, was it reported on the wealth statements? They're able to go back to see is there money going from certain companies to other companies through individuals. They basically have laid out the trail to be able to follow where cash is leaving the business. Along that side, they're looking at payments to other companies. And that becomes particularly important when you're dealing with subcontractors and consultants, affiliates, potentially related parties. Now the government has your entire GL detail and they're very easily able to figure out work share. Remember that subcontract reporting that you did, they can and potentially will take this data to see if they match by option year to provide scrutiny around your work share. This is something that I really encourage all 8A contractors to pay special attention to, 8A and small business to pay special attention to, because the analysis that can become more granular than simply looking at the contract from beginning to end, as the work share requirements are based on an option year period. You may have a base year with several option years, and you need to be able to demonstrate what happened during each of those individual periods, who performed the work, what was performed by the prime, and what was performed by the subcontractors. And that's where your accounting information becomes extremely important. If I was to come into a company and ask to see your accounting system, would I be able to identify those costs? Can I easily reconcile your payroll to the general ledger? Can I identify subcontractor cost by project? Can I trace a payment from the general ledger back to an invoice agreement and ultimately the bank? This is really important because when we are responding to these requests, having this information readily available can demonstrate that you complied with the SBA's requirements. Being able to say that you comply and be able to demonstrate that you can comply are two very different things. So that's really the big takeaway that we've been seeing, is that compliance is not something that you think about only when applying to the program or completing your annual review. You need to think about documentation and accounting infrastructure throughout the year so that if the SBA comes back 2 to 3 years later and asks what happened, you can actually prove it. And that really takes us into the next significant change that we've been seeing with the 8A program, which is the removal of the rebuttable presumption. So historically, SBA regulations included a rebuttable presumption that certain members of designated groups were socially disadvantaged. That approach had already been effectively inoperative since the 2023 court decision, But what SBA is now doing through rulemaking is formally removing that rebuttable presumption from the regulations for individually owned firms and establishing a new standard. I just want to point out that this does not change the eligibility framework for entity-owned firms such as tribes, ANCs, Native Hawaiian organizations, or community development corporations. It really is a fundamental shift from a presumption to an individual evidence-based demonstration. And that's really important because applicants are not going to be able to simply rely on membership in any particular group. The focus is going to be on whether they can establish a social disadvantage under SBA's requirement using specific verifiable facts and evidence. From a practical perspective, think about this as a documentation exercise when going through it. What specifically happened? What discrimination or bias did the individual experience? How did that experience actually affect the individual's opportunities? What evidence exists to support it? That tends to be a very different exercise than checking a box upon membership in any particular group. I think that the broader theme here is that this connects directly to the enforcement that we just talked about on the prior slide, where we're seeing that the 8A program is putting a great emphasis on evidence. They're basically saying, don't tell me you're eligible, demonstrate to me that you're eligible, and don't tell me you complied. You must prove that you complied. That is a big risk for contractors who are not currently operating under those standards. And for those of companies that are thinking about applying to the 8A program, it means you really need to understand the requirements before you begin the application process. For existing 8A participants, I think the larger takeaway is that part of this broader shift in the program is more towards documentation and scrutiny. So whether we're talking about eligibility, financial transactions, subcontracting, ownership, control, and work share, we really should assume that SBA may eventually ask you to substantiate what you're representing. And the best time to build that support is when the activity actually occurs, not 2 to 3 years after the fact when you're trying to reconstruct it for the SBA request. And with that, it kind of takes us into our next shift, which is the fixed price contracting executive order 14402. This executive order came out and essentially established that most contracts coming out from the federal government should be defined as firm fixed price with the preferred method for procurement. If an agency wants to use a non-fixed price vehicle, whether it's cost reimbursement, T&M, labor hour, the contracting officer generally has to provide justification in writing for the agency to approve. That goes a little bit even further, where agencies were directed to review their 10 largest non-fixed price contracts and where practical, look for opportunities to modify, restructure, renegotiate them towards fixed pricing or performance-based incentives. I have seen this done through option year executions on current clients where the government has come back to basically renegotiate T&Ms into fixed price contracts. So when we talk about this with our government contractors, it isn't something to just think about for future procurements. It could also affect your existing portfolio today. And from a finance perspective, the most important question you can ask yourself is, where does the risk sit? When we talk about cost reimbursement contracting, the government generally retains most of the cost risk. Same with T&M. There is still some protection because you're billing based on labor hours with an established rate. But when we move into firm fixed price contracting, the economics change between the government and the contractor. You essentially are agreeing to deliver a scope for a fixed amount. So what you thought might take 10,000 hours and it takes 13,000 hours very quickly becomes your problem. If you price it incorrectly from an indirect rate perspective, the government is not going to necessarily give you additional revenue to make up for that difference. So if your overhead increases, your staffing mix changes, your subcontractor costs increase, your price is still fixed. And that's why I broke down into the slide really the three main areas, which is price it, manage it, and protect your margin. So under pricing, you really want to be able to define the scope. If you don't understand exactly what you're committing to, it's very hard to build a reliable fixed price. When you're working through that, take a look at your labor mix. What is actually going on to perform the work? What are their salaries? How many hours will they need? Can you change out any labor categories? Can you make swaps between subcontractors and employees? And most importantly, use realistic indirect rates. I've seen contractors price using artificially low wrap rates just because they're trying to win. That is a business decision that only the business can decide to make. You may win the contract, but you may also win yourself 5 years of bad margin. The second area is managing it. One of the biggest mistakes we see is that once proposals get completed and the contract is awarded, the proposal essentially just goes into the drawer. So project managers should know what is proposed, and we should be tracking how we're actually performing against that proposal. If we're halfway through the period of performance and we've already burned through 80% of the hours, we have a problem. So we really want to watch scope creep, and especially with fixed price, these seemingly small customer requests can very quickly become additional hours that you're funding with no additional revenue. And finally, protecting your margin. Finance really needs to be monitoring actual indirect rates against what's priced. Look at your wrap rate, look at your labor mix, update your estimate at complete. Don't just wait till the end of the contract to calculate whether you've made money, because ultimately the biggest financial takeaway from this shift towards fixed price contracting is that your costs are not certain and your costs are not certain and your profit is also not certain.
Yeah, one recommendation I would make, Jen, is that, like you said, under protect your margin and indirect rates, even though you might be fixed price and or time and material, consider doing actual indirect rate computation once a year for your full year rate. And I would suggest using the DCA ICE model or template to ensure that you come up with the rate based on the way they would look at it. I think would help you immensely.
Yep, I completely agree. And with that, I will let Paul take over for the changes within the Revolutionary FAR overhaul.
All right, thank you. And we forgot to put one piece in, and that was relating to the DEI. There's no slide, so I'm going to talk about that first real quick, and then we'll go into the FAR overhaul. So as you probably are aware, back in March, the current administration under Executive Order 14398 is basically eliminating DEI. The reason why I'm concerned and why it's worth mentioning is many people have government contractors, especially in the defense world. I see things on websites that sound DEI-ish, and I just encourage you to have your lawyer and so forth look at that. But it applies to primes and subs. One of the issue with subs, maybe not with you, but a large government contractor, like if they're building an airplane, they may have 20 or 30 subcontractors, and it doesn't matter. Even if you give someone a purchase order, this DEI will apply to them relating to this award. It targets race-based disparate treatment and covers employment, contracting, program eligibility. So the gist of it is, if we were to give one sentence, it's the contractor certifying that they do not engage in race-based or protected class-based disparate treatment of the type defined in the executive order. So that impacts hiring, promotion, vendor, training practices, internal eligibility, and participation in programs. And the last thing, and there's so much to say on this, but many of these things we're just bringing to your attention. You know that noncompliance could be suspension or termination of contract, false claims liability, which to me seems a little bit unfair. And usually false claims comes in when you're invoicing, treble damages, and whistleblower initiated actions such as TTAM or QUITAM, where you have a whistleblower. So, you might have somebody on your staff who doesn't like this. Just be prepared and aware, get your lawyers involved. So going to the Revolutionary FAR overhaul, what changed? Well, the purpose was to reduce 25% of the regulation itself. I don't know if you've ever seen the government regulations. There's something called the Paper Reduction Act of 19 something or other. And yet you see all these procedures seem to go larger than smaller. But they say they reduced 25% of it and 22,700 acquisition mandates. So the procurement's going to be streamlined. And the areas it really affected as far as change, as far Part 12, which deals with acquisition of commercial items, 15, which deals with some of the pricing and negotiation, and 16 with the types of contracts like fixed price, time, and material. So what did not change? And that's probably the thing most of us probably wish did change. The core compliance framework and infrastructure for cost reimbursable contracting has not changed. So anything talk FAR overhead all day long. If you've got a cost type contract, you're still have requirements. If you have cost reimbursable, you know the requirements increase. And there's this clause, it's just worth mentioning. It's FAR 52.216-7. It's the allowable cost and payment clause, and it's unchanged. That's the clause in your contracts that makes you have to prepare this incurred cost submission a la the DCAA ICE template. And of course, all of this brings in DCA's oversight as well. So DCA hasn't gone away, although they have some issues, which we'll talk about later. So you're quite aware, I'm sure, the FAR Part 31.2, subpart 31.2 cost principles. No changes to allowability, applicability, reasonableness, just minor changes. There was one place that personal use of auto was put in twice under compensation and under travel. No, they didn't get rid of it. They just got rid of the under compensation. And then there were a lot of nice definitions when I was looking through there about applicability and how they defined it. They removed them all. The problem is they put it under, they say it's under CAS, cost accounting standards. Most people won't qualify and may never see it. But nevertheless, it's gone. FAR 15.FAR, that's the part that deals with contract pricing by negotiation. That's where the government says, hey, I want all the details on your contract cost and pricing data. That has not changed. The table 15-1, that is a certain format that they want it in. If you've learned about it and you do that, or even if you're not required, but you still have that backup, that's most helpful. And something called the certificate of cost of pricing data for that has not changed either. All right, we'll move on to the reforms. And here we go. So we're actually now working on, I hear, the 2027 National Defense Authorization Act. So the big picture for 2026 is, of course, a lot of money, almost $1 trillion is spent on the government, and they're trying to change things. One of the things that's interesting is that they're trying to, through the NDAA, codify prior executive reforms, so through the executive order, so that there survive administrative changes, which we have been talking about. So some of the key provisions note the NDAA only applies, what I'm going to talk about now, to defense contracting. It does not impact civilian contracting. So there's going to be a little bit of both. They have put in the best value standard for the multiple award schedule rather than lowest cost. So the best value is defined as expected outcome that provides the greatest overall benefit. The response requirement. TINA, Truth in Negotiations Act, used to be $2.5 million. Now it's $10 million, but under only defense. So in the past, it was paired with the minimum level of cost accounting standard coverage that's broken apart. And actually, for cost accounting standards, it used to be a trigger contract, $7.5 million. That has been completely eliminated. And now it's $35 million for modified CAS, for CAS standards. Full CAS coverage went from $50 million to $100 million for disclosure statement as well. As far as bid protest reform, just be aware, if you were an incumbent and you have a quote unquote meritless reason for a GAO protest to continue an extension or a bridge contract, they may withhold some money from you up to 5% and keep it. So you don't want to have a meritless GAO protest. The last thing that's notable is the non-traditional defense contractors. If you haven't had full coverage for almost a year or more than a year, you're not covered by FAR Part 31.2, Certified Cost Appraising Data in Business Systems. The problem is most small firms don't have CAS coverage. So something about that's going to have to change. The last and but least is the DCAA, and they're kind of a little bit under stress right now. And we'll move the slide. There we go. So basically what happened in 2025, Trump tried to reduce the federal workforce by having something called the Deferred Resignation Program, impacting DCA. They went from 4,800 to 3,900, 900. That's almost 25% or close, maybe 20% of their entire workforce. With the loss of that experienced, who retired, the most experienced, they're losing a little bit of their institutional knowledge. And so when their audit's being done, you're probably going to deal with someone that's a little bit more like an intern, not an intern, but a less experienced auditor. And that should be something you should be aware of. They've also lost a little bit of autonomy. The leadership at the Department of War wants to take the control of that. So there's certain things that DCA can't move forward where they used to be cloistered or sequestered. They're now like under the scrutiny and under the eye of the Secretary of Defense or War. And so they can't make immediate things. And then once the management decides at the top level, secretariat level, they have to comply. And to do complying takes quite a bit. So the last thing is they kind of don't know what to do with this non-traditional defense contracting because they don't know how to deal with it. And I do kind of understand and feel their pain. And maybe they'll make special rules that if you're under that, it's like an other transaction agreement where basically it's not covered by the FAR, but has FAR-like things. And then DSA would only audit the terms and conditions. And one last quick point before we run out of time here is there is the last slide, if you move to that. And these are the proposed changes in the ICE template. There we go. And just so you know, if you're familiar with the ICE, you have to be familiar, or else this doesn't really make a lot of sense. There's a tab K, section K, and basically what it is it's just sprawling. If you have multiple delivery orders, time and material, and you might have 30 labor classes, you've got to track all of those, and it takes quite a bit of effort. So they're talking about eliminating that, eliminating payroll reconciliation, that's book versus accrual, or like a 941 rec. Contract closing, eliminated, but DSA will keep something that they're working on. But if you notice in the far right block, these are things DCA has agreed to. The last two is a subcontractor administration, where you have to put in all this detailed subcontractor stuff. That's in there as well. And so that's just a lot for a government contractor to do. And normally DSA does assist audits for that purpose of the subcontractor. Right now, they're not doing it. And lastly, this part under cumulative cost claimed and bill, they want to eliminate that. And DSA is looking to see, to what degree they can do that, what impact that would have. So sorry to rush that along, but at least it gives you a sense from Jen and I, if you have some quick questions on the regulatory changes.
So there's two questions that have come in. I can answer the first one, and then hopefully, Paul, we have time for the second one. If not, we can reach out to the other Paul who asked the question directly. So the question was, what do we think about SBA's attempt to change the small business thresholds and reclassifying almost 115,000 large businesses as small? So I think that the SBA is really trying to solve a legitimate problem, which is that successful small businesses can quickly outgrow their size standard before they're actually prepared to compete in the full and open markets. But it might be a little bit of an overcorrecting. If they really do reclassify 115,000 large businesses as small, we're drastically changing the competitive pool for the small business set-asides. And companies with hundreds and thousands of employees could be potentially competing against a $5 or $10 million contractor that they're both now considered technically small. So that's kind of my thought on whether the thresholds should increase. They probably should, but if we're increasing them, we really dilute the purpose of the small business program.
Okay.
Go into that a little bit more. The second one, I don't know if you saw it, Paul, but
yeah, I do see it.
Yep, for the OMB rule
Yes,
issued.
I can respond to Paul. Hopefully, if we go over just a minute, we'll be allowed to. But basically, what Paul's asking is that the new revision to the uniform guidance is the removal of fixed amount awards, which was kind of nice. It had a limitation, first of all, of up only to 500,000, but they have eliminated it. It was mainly useful if the subcontractor basically or sub-awardee didn't have a lot of compliance, wasn't able to comply, and therefore if it's fixed, there'd be less compliance requirements. But I wish it would stay, but that is a proposed to be removed. And I see one last question. And
Um, yes, as long as we have time with the application for 8A, WSB, EDWOSB, and to the SBA, how long is it taking? We have seen firms take over a year lately to achieve 8A status. The one thing that we keep telling them is just follow up with their SBA rep to see if there's anything outstanding, if there's anything. But there is reduced staff. There's lots of changes within the organization and within the policies, and just understand that it is going to take time.
there we go.
Perfect. Our contact information is here. If you have other questions, please feel free to reach out to us. We're happy to help, happy to answer any other additional questions. Thank you to the National Small Business for allowing us to host this presentation. We look forward to doing it again in the future.
Thank you. Bye-bye.
Of course. Thank you both for a great presentation. As a reminder, today's webinar recording and presentation materials will be posted on our website along with all of our past webinars by the end of day. Thank you all again for joining us today. This does conclude our webinar, and we hope you join us for our future NSBGCA webinars. Thank you and have a great day.